This is Al Brooks. Thank you for watching the Brooks Trading course. This is the first of 5 videos on trading broad bear channels. I want to begin by defining what I mean by a broad bear channel. Channels are either broad or tight. And broad bear channels are not common on 5-minute charts because the average 5-minute chart has about 100 bars on the screen, and you usually will not notice a broad channel until it's had several hundred bars. Broad channels have major highs in them and minor highs in them, and the major highs are the important ones. As long as the bear trend is making a series of major lower highs, it's still a bear trend. Here are some bear channels. When the market is in a very tight bear channel, pullbacks are small and do not last many bars, very difficult to make money buying, and therefore you should only look to sell. You can sell with limit orders, sell bull closes forming lower highs. You can sell below bars with stops. You can sell for any reason, but you have to be looking to sell. On the other hand, when a bear trend is forming lower highs, but the pullbacks are lasting many bars and there are many big bull bars within the pullbacks, you have to be selling because it's still a bear trend. However, a lot of traders will also buy reversals up from prior lows. Bulls are buying in a bear trend. They should only be scalping. Bears are selling in a broad bear channel, a bear trend, so they can swing or they can scalp. Broad channels have a lot of time in trading ranges, and therefore a lot of traders prefer just to buy low, sell high, and scalp. Whenever a market's in a trading range and you really cannot discern whether or not it's in a trend in addition to the trading range, traders will look to buy low, sell high, and scalp, and if the legs up and down are big enough, they'll sometimes swing part of their position. You sell reversals down from rallies, and you buy reversals up from sell-offs. A broad bear channel, it's still a bear trend, and therefore traders find it easier to make money selling rallies. Risk reward tends to be better, and the probability is higher. The probability is higher that you're going to make new lows, and the risk of buying here with a stop down here versus selling here with a stop up here is about the same, but the probability is greater for the bears, and the reward is greater as well because we're probably going below that low. Trading range has legs up, it has legs down, has legs up, legs down. This is also a broad bull channel, has a higher high and a higher low, but during most of the time here, it's simply a trading range. Whenever the market's in any kind of a broad channel, most of the bars are also in a trading range. Here we have a broad bear channel, and most of the bars are also in trading ranges, small trading ranges, sometimes nested inside of bigger trading ranges. This is a trading range attempt. Here's another trading range attempt, and another one as well. And trading ranges often have strong swings up and down, strong bull breakout, big bear reversal, big sell-off down here. And there are often channels within trading ranges. We have a bear channel here with lower highs. We have a bull channel here with higher lows. Bear channel there, and broad bull channel there. This is a 5-minute chart of the E-mini, and you can see it begins in the upper left, and it continues down to the lower right, and therefore it's a bear channel. But within the bear channel, there are legs up that sometimes have 20 or 30 bars, and the market is sometimes always in long. And therefore, there are times when it makes sense to be trading on the long side, even though it's a bear trend. Now, this chart has several hundred bars on it. When I'm trading, I'm only looking at about 100 bars. Therefore, I'm not going to be trading this. If I'm going to be trading all of these bars, I'm going to be trading them on some other time frame chart where all of these add up to maybe 100 bars. For example, here's the 30-minute chart. You could sell here, and the market stayed in a relatively tight channel, and you could hold short the entire time. If I'm trading these same bars here on the 5-minute chart, that's not how I'm going to trade it, because there are times when the market is always in long. So I'm going to be buying and selling. I'm only going to be looking at 100 bars at a time. For example, this is about 100 bars. And during this 100 bars, there are times when I'm going to be buying and other times when I'm going to be selling. Whenever you're trading, you should only be looking at 100 bars on the screen, maybe 150 bars, and you trade the bars that are in front of you. However, to see a broad bear channel, you have to look at 200 or 300 bars because you usually need at least 3 legs up and down to conclude that it's a broad bear channel, and several of the legs will have 10 or 20 or more bars, and that means you often have to look at 200 to 300 bars to see the broad bear channel. If your intention is to simply sell and hold short through all of these rallies, then you're not trading it on the 5-minute chart. You need to be trading it on the next higher time frame chart. On the 5-minute chart, you're only going to be looking at 100 bars, and you're not going to be holding short when the market becomes always in long. And you'll see this throughout all of the videos on broad channels. Many of the charts have 300 bars, 500 bars, or even 1,000 bars. And I have to put that many bars on the screen to illustrate the broad channels, up or down. However, that's not how I'm going to trade. I'm going to be trading 100 bars at a time, and sometimes those 100 bars are up, and I'll be buying as it's going up. If I want to be trading it as a broad bear channel, for example, selling and holding through all of these rallies, I'm not going to be looking at this chart. I'll be looking at some higher time frame chart where the broad bear channel from the 5-minute chart is a tight bear channel. So I can sell and just hold all the way down. The market is in a bear trend. It begins in the upper left, goes to the lower right, and along the way it's forming lower lows and lower highs. It's getting some higher highs. It's going above minor highs along the way, but it's forming a series of major lower highs. A major lower high is a high that is a very strong sell-off, usually to a new low. For example, this is a major lower high. This is a major lower high. Broad channel. Most of the bars are also in one or more trading ranges. For example, if you only were looking at this part of the chart, you have a higher high here, you have a lower low here, expanding triangle, and then you have a higher low here. It looks like a trading range. It is a trading range, but it's also part of a broad bear channel. Another trading range. And within big trading ranges, there are usually smaller ranges. For example, here's a head and shoulders bottom within this bigger trading range. Whenever the market is in a section that looks like it's dominated by trading range price action, traders tend to trade it like a trading range and pay less attention to the broad bear channel. When the market's doing this, traders are buying low, selling high, scalping. Same with here, even though it's also still in a broad bear channel. When traders are trading, they're not looking at 300 bars like this. They're looking at 100 bars, day traders at least, and they're trading the day or the session in front of them, and they're not worrying about the sessions before or after. It's the same channel that I just showed you, but now I have it drawn as a line chart. You can see it's a bear channel. A broad bear channel is simply a trading range that is tilted slightly down. You can see it's basically a trading range that has a little tilt to it. It has deep pullbacks, and the more it looks like a trading range, the more traders tend to trade it like a trading range. They ignore the minimum bear trend. In this particular case, before I tilted it to horizontal, it had a minimum slope going down, and most traders would rather trade it like a trading range, buy low, sell high, and scalp. If a broad bear channel is steeper down, they'll tend to swing trade more. Let me talk about some of the features that I look for when I'm deciding whether I should only sell or if I should both buy and sell. Unlike a tight bear channel, if you're starting to get pullbacks that last 5 or more bars, and a lot of the pullbacks last 5 or more bars, chances are the channel is going to be broad. Also, I look at the size of the pullbacks. An average scalp, the smallest scalp in the E-mini is 1 point. And if you're looking at a 5-minute chart and a lot of the pullbacks are averaging more than 3 times the size of a minimum scalp, in other words, 3 points or more, then the market is probably not in a strong bear trend. It's probably either in a trading range or a broad bear channel, in which case you can both buy and sell. I pay attention to the size of the bars and the size of the legs compared to the bars. In this particular swing, the average bar is maybe 8 to 10 ticks tall, and if the legs are 2 to 3 times the size of an average bar, the channel is probably broad rather than tight, and that means you can both buy and sell. Often when the market's in a broad bear trend, there are times that it's actually always in long, here and here. It's still part of a broad bear trend, but there are times when it's always in long and it's easier to make money buying. A very strong rally, probably going to form a higher low and get a second leg up. But the highs are still below the major lower highs, and this is a strong bear rally in a broad bear channel. Pullbacks are often more than 50%, and sometimes they're close to 100% of the height of the prior sell-off. Here's a sell-off, and this pullback was well above 50% of the size of the sell-off. This pullback is almost totally retraced this leg down, yet it still formed a lower high, and it led to a lower low. 76% pullback, and this is an 80% pullback, but it's still a lower high in a broad bear channel. Bears and bulls can make money using stop entries. Bears obviously can make money with stops in a broad bear channel because it's a bear trend, but a lot of times bulls can make money buying reversals up from prior lows with good buy signal bars, especially if there's a micro double bottom. We went down, and then we have a bull bar here, so we went up. We have another bear bar, so down again, and then another bull bar. So now we have a micro double bottom. Bulls will buy on a stop, and because the channel is broad, the legs up are high enough so that bulls can make money entering with stop orders. Usually, pullbacks overlap breakout points. For example, the market broke below this low, so this low is a breakout point, and here's the top of the pullback. These are a series of breakout points and pullbacks. The market broke below this low, so this is a breakout point, and here's the top of the pullback. That means this is a stairs pattern, and when the market is forming a stairs pattern, bulls can make money buying at and below prior lows. And when bulls can make money in a bear trend, the bear trend is not all that strong. It's usually a broad bear channel. And a broad bear channel usually has a lot of trading range qualities to it, and it usually typically evolves into a trading range. Bulls will buy reversals up from breaking out below prior lows, break out to a new low, buy a reversal up, same thing here and here, and they can make money doing it. Broad bear channels tend to have a series of trading ranges, and the trading ranges tend to get lower and lower and lower. So it's a trading range and then a breakout, and then another trading range and another breakout. In general, whenever the market's making a trading range, it's in breakout mode, 50% chance of a bull breakout, 50% chance of a successful bear breakout. However, if the market's in a broad bear channel and you look at a higher time frame chart, these trading ranges are bear flags in a bear trend. And therefore, if you only look at the 5-minute chart, chances are the trading range is going to get a bear breakout, even though you think it might be breakout mode and have the same probability for a bull breakout. It does not. If you look back at enough bars, you'll see that the trading range is within a broad bear channel. And that means the probability of a bear breakout is greater than the probability of a successful bull breakout. Here we have a negative gap. We have a pullback, and it went above the breakout point. As long as the overlap is not too big, I still call it a negative gap, and it still sometimes leads to a measured move down. This high, and then the breakout point. This is a major lower high. This is a major attempt at a reversal up. Two important points usually lead to a third point, a measured move down. Even though this overlapped the breakout point by maybe a couple points, it's not that much overlap. It reversed down quickly, and it still led to a measured move down. So we have a high, a strong bear breakout, and then a pullback that failed at the breakout point, and it fell for about a measured move down. Here, this is before we get the pullback, so certainly a measured move target for a failed breakout below this double bottom. Here's a measured move down, but then we get a pullback here, and it's starting to reverse down. I'm starting to look again for another measured move down from the negative gap. Again, this is the measured move from a double top, this high or that high, or this high or that high, or from a failed breakout below double bottom, here, here. Trading ranges typically have both double tops and double bottoms, and when there's a successful breakout, traders look for a measured move. Whenever you have a series of trading ranges in a trend, so you have trending trading ranges, and you get a bear breakout, there's a 60% chance that even if the breakout reaches the measured move target, it's going to test back at least a little bit above the bottom of the prior trading range, at least one tick above that low. Here we have a bear breakout below a trading range, and it went well above the low of the trading range. This is a 5-minute chart. Whenever you have a fairly broad channel on a 5-minute chart, in other words, occurring in 50, 60, 70 bars, not 200, 300 bars, it's typically a wedge pattern. It's a fairly broad channel, pull back more than 50%. Bulls can make money with stops buying reversals up. Pullback lasting a lot of bars, 10 bars. That's a broad bull channel. And when that happens, and it happens only within the course of a day, you don't have to look at several days to see the channel. It's usually going to be a wedge bottom, and you usually get a wedge reversal. Traders will therefore expect a reversal and not for a continuation of the bear trend. Remember, if you're a day trader and here's the start of the day, by the time you believe it's a broad bear channel, you're somewhere down here, you're already forming a wedge, and chances are there's not much left to the downside. Chances are we're going to get a reversal. Again, a broad bear channel, lower lows, lower highs, occurring all within one day. And usually you have to be expecting the day also to be either a wedge bottom or a trending trading range day. Here we tried to get a wedge bottom, 1, 2, and 3, did not get all that far, and ended up more as a trending trading range day. Trading range here, breakout. Trading range here, breakout. Trading range here, breakout. Broad bear channel, lower highs, lower lows, deep pullbacks after each bear leg. And it's also trending trading ranges. You can draw it this way and this way, or you can say this is a trading range breakout in a smaller range. Breakouts are brief, and the trading ranges have a lot of bars. Traders will sell reversals down because we're in a bear trend, but because the rallies last a lot of bars, bulls will buy reversals up, at least for a scalp. We're forming lower highs and lower lows, so it's a bear trend. Easier to make money looking to sell, but the pullbacks are big enough so bulls will also buy for a scalp. By the time a trader is confident that it's a broad bear channel, the day is almost over and there's not much time left for a swing down. Why are broad bear channels not all that common on 5-minute charts? Here are several days of a 5-minute chart. Each day is 81 bars, so this is over 200 bars. Usually, you cannot be sure that the market's in a broad bear channel until there are at least 100 bars. And that is because a broad bear channel has bull legs that last a lot of bars. And by the time you get a couple bull legs lasting 10 or 20 bars, and then you add in the bear legs, you end up with more than 100 bars, more than what you would see on a 5-minute chart on the screen. Usually, to become confident that the market is in a broad bear channel, you need at least 3 legs up and down, And since the legs each have 10 bars, sometimes 20 or 30 bars, you do not have enough bars in a 100-bar screenshot for you to be confident that the channel is broad. Therefore, if you're trading a 5-minute chart and you're only looking at today's price action, you're going to overlook broad bear channels. You'll simply trade what's in front of you, even though today's price action might be part of a broad bear channel that has gone on for 5 or 10 days. If you want to be trading it like a broad bear channel, it's probably better to be trading a higher time frame chart so that you can see the broad bear channel. We're having a series of lower highs and lower lows, and we have a strong breakout to new low. Maybe this is a broad bear channel at the end of a third day in a channel going down. Usually you need at least 3 legs to be sure that you're in a broad bear channel. So 1 pullback, 2 pullback, 3. But it's also possibly a wedge bottom. We could get a reversal up from here. Not enough information to be sure what to expect for tomorrow, and therefore the probability is not as high as the bears want. However, when you look back from this point here, you know in hindsight that this in fact was part of a broad bear channel. Again, if you're going to be trading a 5-minute chart like a broad bear channel, you really should be trading a higher time frame chart. If you're trading the 5-minute chart, just look at the 100 bars in front of you and trade what is in front of you. If you want to be trading a chart that goes back 5 days or 10 days, you probably should not be trading the 5-minute chart. You should be looking at the 15-minute or 60-minute chart. The legs up and down in a broad channel sometimes last 10 bars, 20 bars, or more. And since you need several legs to be convinced it's a broad bear channel, it often is impossible to draw that conclusion simply by looking at today's price action. You usually have to look at several days. If you're a day trader, you trade the 100 bars that are in front of you. While it's nice to know that the market's in a broad bear channel, and it has been in one for the past several days, and it makes you look more for shorts, selling rallies, you don't need to know that as a day trader. You simply trade what's in front of you. Broad channels are much more common on higher time frame charts, 60-minute charts, daily charts, weekly and monthly charts. You can also see them on 5-minute charts, but you usually have to look at several days before they're clear. Usually you have to look at 3, 4, or 5 days. Here, it's 9 days in a broad bear channel, and you're probably not confident that it's a broad bear channel until at least the third day. By definition, a broad bear channel is going to have strong rallies, and sometimes the market's even always in long. You get strong breakouts, 2 legs up, strong sell-off, and a bull breakout above the bear trend line, and double bottom, higher low, major trend reversal. It's reasonable to buy this reversal up. And this reversal up lasted maybe 100 bars, plenty of room for a profit if you're a day trader trading a 5-minute chart. Here we have a slightly higher high major trend reversal. If you want, you can call it a double top major trend reversal. And you could sell that looking for a swing down, and you get out at the end of the day if you're a day trader. Here's a 5-minute broad bear channel that lasted 6 days. Nobody's going to be trading a chart that looks like this. This is basically a line chart. It's a bar chart that is so compressed that it looks like a line chart. Most day traders don't trade charts that look like this. If a day trader wants to be looking at 3, 4, 5 days or more, he's not going to look at a 5-minute chart. He's going to look at a higher time frame chart, a 15-minute chart, a 60-minute chart, and trade that chart. If you're looking at a 5-minute chart, you're not going to look at it compressed like this and trade it like this. This is not the kind of chart that most traders are going to use for trading. I said that if you have a broad channel on a 5-minute chart, it can in fact be a very tight channel on a 60-minute chart. I talked about that 9-day channel on the last chart. Well, this is it on the 60-minute chart. And for most of it, it's a fairly tight channel. And when a channel looks like this, it's usually better only to look to sell. triangle, bear bar, sell the breakout below. Strong follow-through bar, you can even sell the close and put a stop above the top of the most recent bear breakout. Trail stops after each strong breakout to a new low. This becomes a major lower high. You can put your stop just above its high. And then once this reverses down to a new low, and if there are a reasonable number of bear bars, this is then a new leg down, and traders will put their stop just above the top of the leg. This then becomes a major lower high. And if you're trading the 60-minute chart, you're probably holding for several days, and you can continue to hold until there's a clear bottom or until it rallies back above one of your stops. There's an important difference between major highs and lower highs. If the market's in a bearish trend, it needs to keep forming more major lower highs. If it goes above a major lower high, then it's no longer in a bear trend. It's either in a bull trend or a trading range, and therefore you trade differently from how you would trade if the market was in a bear trend. Lots of reversals. Some are major, some are minor. Lots of little moves up and down. Strong sell-off to a new low. And therefore this is a major lower high up here. As long as the market continues to form major lower highs and does not rally above a major lower high, then it's still in a bear trend, and traders will trade it like a bear trend. They'll sell rallies, maybe take profits at new lows. And they don't want to be buying high. If the market were to go above a major lower high, then it would no longer be a bear trend. It would either be a bull trend or a trading range. And therefore, major lower highs are important. That's why I call them major. After each strong breakout to a new low, the most recent high then is a major lower high. And the bear trend needs to stay below prior major lower highs to still be a bear trend. 9 days in a broad bear channel. There are dozens of major lower highs and major higher lows throughout the channel. A minor lower high means just that, it's minor. If the market goes above it, then you still can be in a bear trend. They expect the reversal up to fail and for the bear trend to resume. Broad channels always contain trading ranges. And trading ranges often have bull legs that go above some prior highs. But as long as the highs are minor, then yes, it's a trading range, but it's still also in a broad bear channel. The bulls have to rally above major lower highs to make traders believe it's no longer in a bear trend. We broke out strongly above this high, but the sell-off is not all that strong, plus it did not make a new low, so it's a relatively minor lower high. It's a strong rally here, so it's a fairly good lower high, but it's not nearly as important as this. And here, same thing. We have a sell-off, reasonably strong, but did not get anywhere near the prior low, and therefore it's not really a major lower high. And if the market goes above it, traders will sell. At this point, is it in a bull trend or still a bear trend? Well, it's both. It's in a trading range, and whenever the market's in a trading range, it's always also in a bull trend and a bear trend. Here we're getting higher highs and higher lows, so it's a bull trend. However, we're still staying below a major lower high, so even with this rally lasting a couple of days, it's still a bull leg in a bear trend. Even if it went above this high, a major lower high, but did not get above the top of the bear trend, some traders would still look at it as either a trading range or a bear channel. We could go all the way up here and then collapse in a much bigger broad bear channel. Markets very often are simultaneously in a trading range, a bull trend, and a bear trend. And you don't know what the end result will be until you see what the bars to the right of the screen look like. Here we're in a broad bull channel, we're in a broad bear channel, and we're also in a trading range. That is very common to have all three existing at the same time. If the market just kept going up and up and up, you would say the bull trend began here. So this is part of a bull trend. If the market keeps going down, down, and down, you would say that this is a bull leg in a bear trend. So at this point, anywhere in here, the market is in a bull trend, it is in a bear trend, and it is in a trading range. It's a bear channel, still below a major lower high. Traders will sell reversals down from above prior highs, betting that each prior high is minor, and the breakout will lead to simply a bigger pullback in the bear trend. When the market's in a trading range, even if the trading range is within a broad bull channel, if you're trading the 5-minute chart, you trade what is in front of you. And if it's in a trading range, you buy low, you sell high, and you take quick profits, you scalp. Strong bear breakouts along the way. The market's clearly always in short, traders should be looking to sell. A bull trend lasting 10 or more bars. This bull trend lasted well over 100 bars, 150 bars. Bulls will buy for a swing. Double bottom, higher low, major trend reversal, another double bottom here. Here are the first 6 days of that 9-day broad bear channel. And when you look at the individual days, it's hard to imagine that they are part of a broad bear channel, but they are. Broad bear channels often have strong rallies within them. Here, the market was up almost all day long, but it was a bull leg in a broad bear channel, and it formed a lower high. Pretty good reversal up, good bull bars. It's always in long. Traders will buy, even though it's a bull leg in a broad bear channel. This day had lower highs and lower lows, and it was in a broad bear channel, and the pullbacks overlapped the breakout points. Bulls could make money buying. They didn't know this may have been the low of the day, and it could have lasted all day long from this point. So bulls will buy, and they're able to make money buying. Again, this is part of what turned out to be a broad bear channel. Wedge bottom, 3 reversals up, 1, 2, and trying to get 3 and a micro double bottom. Bulls will buy, even though it's a broad bear channel and it's part of a bigger broad bear channel. Strong bear breakout, traders are selling closes. And then we got a fairly tight bull channel, and bulls will buy for any reason. They'll buy closes, they'll buy above bars. This is a tight bull channel and a reversal day, a bull reversal day inside of a broad bear channel. And then it entered a trading range from here to the remainder of the day. And traders look to buy low and sell high and scalp. Strong bear breakout, traders will sell. And then it entered a trading range. Traders will buy low, sell high, and scalp. It's a strong bull breakout, and traders will buy, betting that we're going to get a swing up. Now we have a double bottom, they'll buy again. Tight bear channel, traders are selling for any reason. And then enter a trading range. Traders buy low, sell high, and scalp. A trading range for the first half of this day. Buy low, sell high. We have a higher low, maybe a higher low, major trend reversal, and we're in a bull channel. Not all that broad, but it's still a bull channel. Traders will look to buy pullbacks. And this is a bull channel inside of a 9-day broad bear channel. So if you're day trading and you're looking at the 5-minute chart, you pay much more attention to the bars in front of you, and you don't worry that these bars are part of a much bigger broad bear channel. Look at these days. None of them look like they're part of a broad bear channel, and you only see them if you look at several hundred bars on the chart. If you're day trading, you're not going to do that. You're going to focus on the 100 bars that are in front of you and trade what you see. And that includes buying, even though it turned out to be a bull leg in a bear channel lasting several days. I began by drawing the distinction between a broad channel and a tight channel. When the channel is broad, you can make money both buying and selling. And since it's a bear trend, it's usually better to focus on selling. You usually cannot tell if a channel is broad until you've seen 100 or more bars, 200 bars. And that's more bars than what you see if you're day trading on a 5-minute chart. Most of the time, if you're looking at a 5-minute chart, you cannot tell that the market's in a broad bear channel. And by the time you decide that it's in a broad bear channel, you're probably near the end of the day. There's an important difference between major and minor highs in a bear trend. As long as the market is making major highs, it's still in a bear trend. And therefore, if it goes above minor highs, traders will sell above those highs, betting that the market will continue to make major lower highs. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the first of 5 videos on trading broad bear channels. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the second of 5 videos on trading broad bear channels. Channels, when they're broad, usually last at least a few days. So if you're trading on a 5-minute chart, that means they'll last at least 200 or 300 bars. As with all bear trends, reversals are common, but most will fail. It's always good to diagnose as early as you can so that you can begin trading appropriately for the chart that's in front of you. This is 9 days in the E-mini, and it's on a broad bear channel. It's in a bear trend. It starts in the upper left, ends in the lower right, and it has pullbacks that are lasting lots of bars and covering a lot of points, and therefore the channel is broad. If you're trading a 5-minute chart, you're not going to be seeing this. You're only going to be looking at 1 day or maybe 2 days worth of bars. However, if you do step back and use a bar chart and compress the bars together, and you can look at a lot of bars like this, you can see that, in fact, the market's in a broad bear channel. As a day trader, that's not all that important. And if you're going to be looking at this many bars, it's better not to be trading the 5-minute chart. It's better to be trading a higher time frame chart like a 15-minute or a 60-minute chart. It's a bear trend, and therefore traders should look to sell, and they certainly should be looking to sell reversals down from rallies. If you do look at a 60-minute chart or a 15-minute chart, let's say you're over here, you'll be able to see that the market is in a broad bear channel, and therefore, in general, it'll be easier to make money selling because the legs down, in general, are bigger than the legs up. My general approach is, if the market's in a broad bear channel, look to sell a pullback. Instead of selling a breakout to new low, I look to sell a pullback that retraces about half of the prior leg down. So you're looking to sell somewhere in the middle third of the prior leg down. And also, you want to be selling reversals down from breakouts above minor lower highs. When the market's in a broad bear channel, it's forming major lower highs, where there are strong breakouts to new lows. That makes the high before it major, and as long as the market continues to make major lower highs, the market's in a bear trend. This is probably a major lower high here or here. Sometimes you get a reversal above the major lower high, and at this point the market's either in a trading range or in a bull trend. However, if it reverses down quickly enough and strongly enough, the market again becomes always in short, and then is either in a trading range or a bear trend. And you can clearly see that even though this rally went above a major lower high here, it simply made a broader channel. It's still a broad bear channel, even though briefly it looked like it might be reversing. If you are using a higher time frame chart, like a 15-minute chart or a 60-minute chart, some traders will put up a 5-minute chart occasionally to find earlier entries. The bars on the 5-minute chart are smaller, and therefore you can enter sooner than on a 60-minute chart, where each bar is made up of 12 5-minute bars. A broad bear channel spends a lot of time in a trading range, and when it's in a trading range like this, you don't know if the bear trend will resume or if the bull trend will reverse up from a higher low major trend reversal. When it's in a trading range here for over 200 bars, you trade it like a trading range. You look to buy low, you sell high, and you scalp. If you want, since it's still in a broad bear channel, you can also swing trade. Let's say you sell here. This is the top of a very strong sell-off. Therefore, this is a major lower high, and traders will place their stop just above that high. If you're willing to take a chance that a trend will last several days, this is where you put your stop. If you're trading a 5-minute chart, you're probably not going to sell here and put a stop up here. But if you're trading a 15-minute chart or a 60-minute chart, and this looks like a reasonable sell, you might be willing to hold positions overnight, in which case you will use a stop above the top of the most recent major lower high. Alternatively, you can simply look to sell every day. If you think the market's trending down, you can expect rallies to fail, and at the start of every day, you look for a rally and look to sell it. Or look for a pullback. Here we have a gap down and a pullback, look to sell it. A rally, sell it. A gap up, possibly the start of a bull trend, but it's still below the top of this entire channel, and therefore it's still possibly part of a bear channel, even though it's above these major lower highs. So traders will sell reversals down, taking a chance that we will not get above these highs or above that high. If you're day trading on a 5-minute chart, you're going to be exiting at the end of the day, or you'll be exiting on a reversal up from a prior low. This is the same 9-day stretch, but it's using a 60-minute chart. You can see the channel down is fairly tight. Pullback's just lasting a few bars. The bulls tried to get a reversal here, but it failed, and somewhere in here it went always in short again. Through here, it clearly is a tight bear channel. First reversal up. Even though it's big, it's still minor, and that means the odds are it'll test down. Because it's in a bear trend and the channel is tight, traders should only look to sell. And anytime there's a reversal, they'll look to sell a resumption of the trend back down. They'll assume that the reversals are all minor and that the channel will remain tight. After each breakout to a new low, if the breakout's reasonably strong, traders will look at the high at the start of that leg down and consider it a major lower high, and they'll put their stop here. Does not matter if you sold here or here. Once it does this, your stop is here. And the same is true here. If you had a breakout here and you put your stop here and you get stopped out, a lot of traders will sell again on a reversal down, a micro double top, taking a chance on bear trend resumption. And at some point down here, you'll conclude this lower high is major, and you'll put your stop up here. Market's sideways here, and a lot of traders will trade it like a trading range. They'll look to buy low and sell high. Since it's still possibly a broad channel down, traders can swing trade the short or scalp the short. If a trader were selling down here, thinking that the market might be in a trading range, he might use a tight stop at the top of the trading range instead of all the way up here or here. If he does that, a lot of traders will look to sell a failed breakout or reversal back down, especially a micro double top. We gapped up here, we traded down. We went up here, we traded down. We went up here again, we traded down. So traders would sell a reversal down. You can call it a double top here and here. So twice the bulls tried to break successfully above this lower high, and they failed twice. We have a double top here with this. Very tight channel again, in fact, very tight channel all the way through here. So traders will sell pullbacks, expecting the pullbacks only to last 1, 2, or 3 bars. For example, they might sell with a limit order at the high of the prior bar, betting that any reversal up will be minor, like this, or this. As with all bear trends, reversals are common, and again, as with all bear trends, most reversals fail. That's my 80% rule. If the market's in a bear trend, 80% of reversal attempts will fail, and therefore it's better to look to sell the reversal attempts than to buy them. Again, 9 days of the E-mini, a 5-minute chart, where the bars are all compressed. Trading range here for 90 bars, trading range here for 250 bars. Whenever there's a trading range, there will be both buy and sell setups, and the bulls will look to buy reversals, maybe a wedge bottom. And here's a strong breakout. Somewhere in here, the bulls are going to conclude it's always in long, and the odds are the bulls will get at least a small second leg up. And the same is true here. You have a potential final flag, a bear breakout, a higher low major trend reversal, and pretty strong reversal up. So in here, the market's always in long. Probably will get at least a little bit more up. Maybe here, maybe here. Broad bear channel. Often the market is always in long, at least briefly. Traders will look to sell a reversal down. For example, here there's a double top. It's a slightly higher high double top, but it's a double top, a failed breakout above that major lower high. And the same is true here. A strong reversal up, but potentially a double top, and traders will look to sell a reversal down. They probably will not sell the first. They might sell the second or third or fourth, but in any case, they'll be looking to sell a reversal down. Some traders will wait until you start to get a strong breakout and then sell. With all trends, the market's constantly trying to reverse, but most reversals are minor and therefore fail. They become either bear flags or trading ranges, sometimes strong enough to become always in long, and that's one of the differences between a broad channel like this and a tight channel like this. A tight channel like this, the pullbacks do not last long enough for the market to become always in long. Bears expect all reversal attempts to fail, and they're looking to sell reversals down. A break above a prior high, they'll sell the reversal down. Or they'll sell at the prior high and use a wide stop above an even higher high. All trends have inertia. A broad bear channel is not as strong as a tight bear channel, and certainly not as strong as a breakout, but most reversal attempts will fail. Most bottom attempts will therefore fail. Market's in a bear trend, so it's constantly forming bottoms, but every reversal leads to either a bear flag and a resumption of the bear trend, or a trading range, which will probably lead to a resumption of the bear trend. The bulls see a wedge bottom, they see a double bottom, higher low major trend reversal, another higher low major trend reversal, lower low major trend reversal, an expanding triangle bottom, lots of little wedges and triangles. The bulls constantly are seeing reversals, but most reversal attempts fail. For example, this is a higher low major trend reversal. You can call it a double bottom, but when the channel is this tight, the first reversal up probably is minor and not going to go very far. The bears look for the reversals to fail, and they'll sell on a resumption of the bear trend down. They'll look for the reversal to fail and start to turn down, and they'll sell again, or they'll simply hold their short position and use a wide stop. The market's starting to reverse down, reverse down, reverse down. Bears will sell, betting on a resumption of the broad bear channel, which means they're betting that we'll get a new low. They're selling up here in a broad bear channel. They're betting that we'll get at least a new low. All broad channels spend a lot of time in trading ranges. So at this point, the market is in a bear trend, a broad bear channel, but it's also in a trading range. And it's possibly in an early bull trend, a higher low major trend reversal and good reversal up. That's common for the market to be simultaneously in a trading range and an early bull trend and a continuation of the bear trend. As soon as you break above any kind of a major lower high, this is not all that major, this is more major. But in any case, as soon as the market breaks above a major lower high like here or here, the market is no longer in a bear trend. At that moment, it's in either a bull trend or a trading range. However, if it reverses down strongly, it's then back to being in a bear trend or a trading range, and the bull trend is over. Whenever the market is in a bear trend, it's regularly having strong reversals up that break above the top of the channel, which is the bear trend line, and then it reverses down again, and you can draw a new trend line, and the channel will get flatter and broader as time goes on. Market's starting to reverse down, so you have 2 points. You can draw a new line, but this line is flatter than that line, and the channel is becoming broader. So it's pretty tight here, but now it's a broader channel. The market rallied here, reversed down. You can draw a new line. Watch how the market behaves. Broke above the line here, reversed down. You can draw a new line, and you can repeat the process. Every time there's a trend line break, you draw a new trend line, and the lines become flatter. The trend becomes weaker and usually broader. Eventually, it transitions into a trading range. Every broad channel contains trading ranges, and some of them last a lot of bars. On the 5-minute chart, this one is lasting maybe 300 bars. When the market's in a trading range, it often goes above highs and then reverses down, and it goes below lows and then reverses up. Sometimes it even goes above relatively major highs, but as long as it reverses down, traders will continue to sell, betting that the bear trend will resume and be a flatter, broader bear trend. Strong reversal up, strong reversal up. If you're day trading the 5-minute chart, the market's always in long for these several hours, and it's reasonable to be long. If you're day trading, you're only looking at this day, and you have a higher low major trend reversal and a strong reversal up. So you're going to be buying for a swing through here. Whenever the market's in a trading range or in a broad channel, second leg traps are common, where the market rallies and has a second leg up, and it looks like it's breaking out into a bull trend, but the second leg fails and the bear trend resumes. All bear trends need a series of lower highs, and breakouts above relatively minor lower highs are common. For example, this is a minor lower high. The top of the bear leg is here or here. Going above this is not enough to end the bear trend. Going above this is a fairly major lower high, so a lot of traders will conclude the bear trend has ended at this point and that it now has evolved into a trading range and possibly a bull trend. This is a breakout above a minor lower high right here. But the truly major lower highs, the most important ones, should continue to hold, and the rally should fail and reverse down below the biggest major lower highs. As with any trade, you should always try to diagnose what the market is doing as early as you possibly can so that you're trading in an appropriate way for what the market is doing. The bears have a fairly tight channel here, so it's a breakout and pretty good follow through bars. The market's always in short. In here, it's a tight bear channel. However, the market becomes probably always in long here or here. And again, same thing here. We're selling off. We have a lower low major trend reversal, pretty good reversal up. The market's probably always in long somewhere here. Yet, the highs are still above the most major prior lower highs, and therefore the bears still have a broad bear channel if you look at the past several days. If you're just looking at today, the bulls have a reversal that became a trading range day. Traders will sell reversals down because they see this entire rally as being above a pretty major lower high, and they'll bet that the market is either in a trading range or in a broad bear channel. We have a reversal down here, a reversal down here, so you can draw a line across these two highs, and then see what the market does when it gets to that pink line. Here it went a little bit above and reversed down. The bulls were hoping for a higher low and a bull trend, but here the bulls gave up and the bears took control again. So the market is back to always in short, even though it was always in long through here. Broad bear channels always spend a lot of time in trading ranges, and within a trading range there are always reasonable buy setups and reasonable sell setups, and the market's always in a bull trend and a bear trend. For example, higher low major trend reversal. In a trading range, what would happen if the market kept going up like this? You would say the bull trend began here, and therefore this is a bull trend. Even through here, it's a bull trend. But it's also still forming lower highs in a broad bear channel. When the market is down here, where did the bear trend begin? It began up here. So this is part of a bear trend as well, and it's clearly part of a trading range. Bear trends need lower lows and lower highs, but a lot of times in a bear channel, you don't get a lower low until the market breaks below the trading range, which means it can go sideways without a lower low for 100, 200 bars. In general, you need to see 3 pushes down before you can conclude that the market's in a broad bear channel. And a lot of times, when you get 3 pushes down, the market's in a wedge and it's about to reverse up. Broad bear channels spend a lot of time going sideways, and sideways means confusion, a trading range. A lot of times it's not clear if the bulls are going to win or if the bears are going to win. And what traders do is they trade what is clear, which means they trade pieces of the legs up and down. Reasonably strong reversal down, totally reversing that reversal up. A lot of bars closing near their lows, market's always in short. Traders will sell, stop up here, looking for at least a small second leg down. If you want higher probability, you wait until the bears start to get consecutive big bear bars closing on their lows, and you could sell here. Tight bear channel, first reversal up, probably minor, which means a trading range. The bulls see 2 legs down with a lot of overlap among the bars, a lot of bars with prominent tails, and they're thinking that this might be a trading range, and therefore the reversals up might be big enough to buy. So 2 legs down, 1 pullback 2. Trading ranges often have 2-legged patterns, 1 pullback 2, 1 pullback 2, and traders like to buy reversals up from 2 legs down and sell reversals down from 2 legs up. If a trader did not want to take this buy because the channel is so tight, he might wait for a major trend reversal. And that's what we have here. You can call it a little wedge here, or a bigger wedge, bear bar, and then second push, third push. So a wedge, higher low, major trend reversal. Certainly an okay buy for a swing up. All major reversals are relatively low probability, 40% chance of becoming a trend. But as long as you're holding for a reward that is at least twice your actual risk, the math makes sense in taking these buys. Some traders want higher probability, and they'll wait to buy the third or fourth consecutive bull close, use a wide stop, and scale in if the market pulls back. However, with a channel as tight as this reversal up is probably minor. Yes, you got a lot of bull bars closing above their midpoints. The odds are we'll get at least a small second leg up. But if I see this and I'm not long, I'd rather buy a pullback. When you're looking at broad channels, broad bear channels, they typically last at least several days. They're bear trends, and therefore reversals are common. And like all bear trends, most reversals fail, and therefore it's better to look to sell a rally from a reversal than to buy the rally betting on a successful reversal into a bull trend. As always, you should try to diagnose what's going on as soon as possible so that you can start trading appropriately. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the second of 5 videos on trading broad bear channels. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the third of 5 videos on trading broad bear channels. Because it's a bear trend, bears will sell, but the market sometimes has strong enough reversals up so that bulls can sometimes make money buying. Also, broad bear channels often are always in long, but the rallies are bull legs in a bear trend. A broad bear channel, but a lot of the rallies are big enough for the bulls to make money either swing trading or scalping. the market's forming lower highs and the market's in a bear trend, traders will look to sell reversals down, even after a pullback this big. This is actually simply a wedge rally, 1, 2, 3, and a double top, slightly lower high double top below the top of the bear trend. Reversal up, but it looks like a bear leg in a trading range or a bear leg in a broad bear channel. Traders will therefore sell reversals down here or here. And then again, very strong rally, but unless it gets above prior significant lower highs, it's more likely that this is a bull leg in either a trading range or a bear channel, and therefore traders will look to sell, especially a very big bar near the top of the channel or the top of the trading range. Traders will bet that it's a second leg trap. First leg is either here, pullback here. Other computers will see the first leg as this, and then pause and second leg up, trapping traders with the biggest bull bar at the top of a trading range and the top of a channel, trapping traders into thinking it's becoming always in long. But the reality is there are far more bears looking for bars like this to come in and sell and overwhelm the weak bulls who are buying too high. If you sold in here, you probably are putting your stop up above the top of the bear trend. A double top, you can also call it a wedge, 3 rallies, 1, 2, 3, even though the second and third rally are at the same price. Wedge bear flag and a lower high. Bear breakout, not very strong. Now we have a small double top here, a triangle. Traders will look to sell a reversal down below a good looking bear bar like that. Head and shoulders top bear flag, left shoulder, head, right shoulder. Or you can simply call it a broad bear channel where you have a pretty strong rally but still above prior major lower highs. If you have a bear trend and it's starting to get fairly deep pullbacks, then it's probably a broad bear channel and not a tight bear channel. And if it's a broad bear channel, bulls will look to buy below prior lows. And some bears will start buying below prior lows to take profits. The bears start to sell rallies instead of breakouts to new lows, and then they take profits. They buy back their shorts once the market falls to a new low. So you get these strong bear breakouts that just fail because at a new low, the bears are buying back their shorts, doubting that the trend is strong enough to continue straight down. So they take profits at new lows. The bulls know the bears are doing that, so the bulls are buying new lows as well. And then the bears are looking to sell somewhere in the middle third of the prior leg down. And the bulls will take profits there because they know the reversals up are probably going to be minor. Here we have 8 bars without a pullback and a lot of bull bars closing above their midpoints. Reasonably strong rally, but tight bear channel and therefore minor, which means it probably will lead to a trading range or a bear flag and a resumption of the bear trend. This is important. We have a double bottom and a breakout. We fell pretty far below the breakout point, either of these lows, but we rallied back above the breakout point. And that means this is a stairs pattern when you have pullbacks above breakout points. What's important to note is that bulls buying lows and scaling in lower are making money. Bulls are making money in a bear trend. That usually means the bear trend is weak. So you have to be thinking that it's probably a broad bear channel and not a tight bear channel. And once bulls see that, they'll start to look to buy at new lows and below prior lows. Not only did this pullback go above that low, we have a second leg up that went above this high. 2 legs up and a higher high, probably a trading range, but still a bull leg in either a trading range or a bear trend. It's important to note the strength of the rallies, and the bulls therefore are confident that subsequent rallies will also be strong. They'll look to buy reversals up from new lows. The bears are disappointed by the size of these rallies. So are they going to be selling at the new lows? No, because they're afraid of another big rally and it might turn into a bull trend. Therefore, the bears stop selling at new lows and they buy back their shorts at new lows and look to sell rallies. Once bulls see that limit order bulls buying below prior lows can make money, In other words, the pullbacks are going above the breakout points. The bulls become more confident and they'll look to buy every new low and scale in lower. We broke below this low, but the bulls see the bulls who bought at that low and lower, or the bulls who simply bought lower, made money. And therefore, if the market falls below a prior low, here, here, or here, bulls will look to buy a reversal up, betting that the market will come back above the breakout point and they'll make at least a scalp. Another new low. Bulls will buy either with a limit order at the prior low and scale in lower if need be, or they'll buy on a reversal up, especially a micro double bottom. We went down and then a doji bar, down again and trying to go up, micro double bottom here. Market broke to a new low. Well, the bulls are making money buying new lows. They're going to keep buying new lows. They'll place a limit order to buy at this low or at that low. And if necessary, they'll buy more lower. Some prefer stop entries and they'll buy on a reversal up, especially if there's a micro double bottom and a second entry buy. The scaling bulls will take profits at their first entry price. So let's say they buy here and more 1 point lower, and the market gets back to their first entry price. They'll exit at their first entry price, break even on their first buy, and with a profit on their second. Or they may exit part of their trade there and then hold on to one of their positions, half of their position, hoping for a swing up. An example of bulls holding for a swing up, and if they see a reversal, a bear bar, after a big breakout bar like that, and they look to the left and they see that this is not above everything, it's still either in a broad bear channel or a trading range. Both cases, they want to exit on a reversal down. At every instant, traders are constantly trying to decide if they can structure a trade where the probability is 60% for the next few bars going up or down. We have a reversal. We went up, we went down, and this is probably a bear flag. Chances are we'll go sideways to down at least a little bit. Chances are 60% or so that we'll get at least a small second leg down after a parabolic wedge top. And therefore bears will sell a reversal down, especially below a bear bar. We went up on this bull bar and then we paused. We went up again on this bull bar and now we have a bear bar, about a 50% pullback, two small legs up. This is probably the first of two legs down because the channel is very tight and bears sell looking for one more leg down. At this point, we have three consecutive bear bars closing on or near their lows. Strong enough sell-off through here so that if we reverse up, we'll probably get at least one more leg down. The market now is sell to close. They either sell this close or that close, betting that the next reversal up will fail and probably become a bear flag. It's always higher probability to sell the closes after you see a strong breakout. And whenever you take a higher probability trade, your risk reward is always worse. Usually what it means is the stop is further away, so you're forced to risk more. If you sold here, this is what you got afterwards. But a very tight channel. Even though it's two legs down, it's still a very tight channel. So this reversal is probably minor. The bulls are hoping it's two legs down and what will become a trading range or a bull trend. Leg one, pullback, leg two. So a high one and then a high two here, second entry over here. But very tight channel. More likely this is a minor reversal leading to either a trading range or a bear flag and a resumption of the bear trend. In any case, the bears are disappointed by the sell-off and they'll look to take profits or to exit on a second reversal up. Here it would be a third. It went above this bar and then it went above this bear doji bar. Not a good enough reason to exit, but now we have another bull bar, so they'll exit here or they'll wait until they see two or three pretty good bull bars and then they'll exit at the market. The bulls will buy. They know it's a tight bear channel And the bears are disappointed by this bull bar and the buy signal triggering, and then a big tail here, and then another big bull bar here, and now another buy signal bar here. And therefore the bears are going to be buying, even though it's a bear trend. It's low in a bear trend, and the selling is starting to become disappointing, the follow through. That increases the chances that the bear trend is not a strong bear trend, instead that it is a broad bear channel. We have a 9-bar bull microchannel at this point, and therefore the odds are we're going up at least a little bit more. And a lot of traders will look at that and say it's always in long. A lot of overlap among the bars. We're still only at the breakout point and not above any major lower high, so it still might be a bull leg in a trading range. However, the odds are we're going up at least a little bit more, so a lot of the computers will see the market as always in long at this point, right here, that bull bar. You can either put your stop above this high, thinking that it's fairly major, or certainly above this high, the top of the entire bear leg. Broad bear channels often have legs that are strong enough to make the market always in long, but those are bull legs in a bear trend. Fairly tight channel, pretty good rally here, 9-bar bull micro channel, and now a higher low major trend reversal. 40% chance if you buy here, we're going to get a swing up. It's a reasonable buy. At some point, the bulls give up. Very strong breakout here, probably at least a small second leg sideways to up, and they have it. And then we're starting to reverse down from a double top. If you want, you can call it 3 pushes up, 1 pullback, 2 pullback, 3, and therefore it's basically a wedge top and a lower high. Bulls should take profits, concluding that instead of the market entering a bull trend, it's probably a bull leg in a big trading range. The bears see a wedge lower high and a possible bear trend, and they know a lot of the bulls will give up after 2 pushes up and not much progress. The bears will sell, either for a scalp, taking a chance that it's going to be a trading range, or for a swing, hoping that we get a big second leg down. Leg 1, pullback, leg 2. A wedge higher low, 3 reversals up, 1, 2, 3. Testing the bottom of the bull breakout here, the double bottom bull flag, higher low. Reasonable buy, the bulls might get a swing up. Wedge bull flag. You can also call it a high 1, high 2, high 1, and then the second leg down subdivides into 2 smaller legs. Doesn't matter, but it looks like a pullback from this breakout. What took place right here? We have 5 bear bars, 3 of them decent sized bear bodies closing on their lows. A lot of traders see this as back to always in short, but it's confusing. The bulls have a wedge bull flag. They have an II buy, a second entry buy, 1 and then 2. A lot of the bears who sold here are not going to like 2 legs down in a trading range, and they will get out. And the bulls will buy for a scalp or a swing. The bulls are hoping we're getting a series of higher lows and a bull trend. Disappointing reversal for the bulls. Now the market is confusing. A tight trading range inside of a trading range to here, inside of a bigger trading range to here. Bears have a reason to sell, the bulls have a reason to buy, but this is disappointing, and a lot of the traders will simply exit and wait. Whenever the market is in a fairly tight range like that, and you're not sure if it's always in long or short, I keep looking to the left to find the last time things were clear. And here we have 5 bear bars, 3 of them pretty good bear bars. Also, it might be still in a broad bear channel. And therefore, even though it's in a tight range, it's probably slightly more likely to get a bear breakout than a bull reversal up. The bears are hoping for head and shoulders top, bear flag. A lot of the bulls will take profits below these bear bars. Bears might sell more for a swing than for a scalp. The reason why I say that is if they're selling below a bear bar here or a bear bar here, they're right at a prior low at the bottom of a tight range. Probably not enough reward for a scalp. So if you're taking a short, this low down in a range, you probably have to be taking it for a swing. Next day, big gap down. We have a wedge bottom here, 1, 2, 3, inside of a bigger wedge bottom, 1, 2, 3, and therefore it's a nested wedge. That has a higher probability of a swing up. This is what I mean by the nested wedge. The third leg of the wedge is itself a smaller wedge. So there's a smaller wedge inside of a bigger wedge. That increases the chances of a reversal, at least a couple legs sideways to up. You also have an expanding triangle. We have a low that reversed up, a new low that reversed up even further, and now we have a third low that's trying to reverse up and a second entry buy above that bar. This is a good reason for bears to get out of shorts, and bulls will take a chance and buy. If the bulls swung part of their position, they ended up with a good profit over the next couple of days, today and then the next day. The market's beginning to channel up, forming higher lows and higher highs in a pretty tight channel. And then at the end of the day, we got a pretty strong rally. The next day we gapped up. We had a pair of bear bars, but we have a small high 2 bull flag. High 1 above this bear bar, and then a high 2 above that doji. Bulls will buy, hoping for a resumption of the bull trend. Can you buy this close? Well, if you're willing to hold overnight, you certainly can. Most day traders are not going to buy the close at the end of the day. They'll wait to see what happens on the next day. But if you're willing to hold for a few days, then yes, it's buy the close. Where do you take profits? Well, one way to do it is look for resistance, and a common resistance is a measured move target. We have a gap below this low and above that high, and therefore we might get a measured move up from this low to that low, which is right here. And you can see some bulls did take profits there. We have another gap. This pullback did not fall below that breakout point, and therefore this is a strong rally, and this gap might be a measuring gap leading to a measured move up. Maybe from the height of this bear leg, we'll get a measured move up. We did. A lot of traders do not like to take trades in and out, in and out, in and out. The reason why is a lot of times it's hard to get back in. You get out, you get in, you get out, you get in. After 2 or 3 times you've been scalping, you just run out of energy, plus you become satisfied with the profit that you have. And the result is you end up missing a huge move. And that's one of the reasons why traders should focus on swing trading. Higher, low, major trend reversal. The market went always in long. We broke above a high here. But then we started to reverse down, and it's still below this high and certainly still below that high. So some traders who sell here would just not get out. They'd keep their stop either above this bar or above here, taking a chance that any reversal is minor and that we'll keep getting new lows. Possible second leg trap and a bear trend, 1 pullback 2, nested, 1 pullback 2. Is it still always in short? Well, if you're just looking at this chart, at the close of this bar, it's always in long. But if you're looking back over the past 100 bars, you can say, well, maybe on a higher time frame chart, it's still short, and therefore maybe we'll get another leg down. So a lot of these bears will not get out, even with this higher low major trend reversal and a strong bull breakout. Typically, if I'm trading and I'm short for any reason, I will get out. But I'm a day trader. I know that when I see this, the odds are we're going up higher. And when I see this breakout, the odds are the first reversal down will be minor, and that will come back up and test that close. Expanding triangle. Trader might get out if it is short down here, especially a micro double bottom. If he did not get out here, he would wait for a strong breakout and then conclude that the bulls have taken control. And here we have a couple pretty good bull bars. It's also the end of the day, but a lot of the traders who bought up here are concluding now that we have an expanding triangle, we have a nested wedge, and there's a broad bear channel probably soon evolving into a trading range or a bull trend. They're looking for reasons to get out, especially by the end of the day. And consecutive or nearly consecutive bull bars with decent bodies and closing on their highs that's a good reason to get out. It's a bear trend. It's a broad bear trend and therefore not particularly strong, but bears should be looking to sell. And if the rallies up are strong enough, bulls will look to buy as well. And sometimes the rallies are strong enough to make the market always in long, at least briefly. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the third of 5 videos on trading broad bear channels. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the fourth of 5 videos on trading broad bear channels. A bear trend needs lower highs, especially major lower highs. A major lower high is one that leads to a strong breakout to a new low. Second leg traps are common in broad bear channels because broad bear channels are very similar to trading ranges that are just sloped down somewhat. You get a strong second leg and traders think it's going to lead to a strong breakout with follow through, yet it quickly reverses and traps traders into either buying too high or selling too low. Because the channel is basically a trading range that's sloped downward, bulls can make money by buying new lows and adding on lower. And a lot of times they'll use wide stops. In a bear trend, bears trail their stops to above the most recent major lower high. A major lower high is a lower high that leads to a strong reversal down or a strong breakout, usually to a new low. So this is a major lower high. And similar to this, we got a strong breakout. At this point, this is a major lower high after you've had a strong breakout, even though it's still not yet to a new low. And as soon as the market makes a new major lower high, has that strong breakout, wherever the bears had their stops before, they move their stops to just above the most recent major lower high, and that is called trailing the stop. We have a strong breakout to new low. Is this a major high? Well, it probably is after that many bars down. A lot of traders would still consider this to be the major lower high because this reversal up is so minor. Took a lot of bars, but we broke to a new low. We have a gap down and another breakout here. So this is a major lower high. Now, is this a major lower high? We broke strongly to a new low. Some traders would consider this a major lower high and they'd put their stop above. And if they got stopped out, they would sell on the reversal down. When you have a sell-off that has repeated reversals, a lot of traders go all the way back and label this as a real major lower high. It has other highs that are fairly major here and here, but a lot of traders would keep their stop here until the market broke strongly to a new low, maybe here, maybe here. It's unclear to me. Some traders would get out here and say this is major, others would do here. Both are okay. When you use a tighter stop, you're going to get stopped out more. When you use a wider stop, you get stopped out less often. And as I said, if you do get stopped out, you just sell again on a reversal back down. We have a breakout below a bull channel, a bear flag, strong breakout. Therefore, this is a major lower high. We have another strong breakout here. At this point, after a little bit of follow through, even though it's not at a new low, a lot of traders would consider this pretty major. And if the market rallied above it, they would get out, but sell again on a reversal down. This is clearly major, certainly by this point. We have a breakout to new low, pretty strong breakout. The bears do not want to see the market get above this high because if it does, then they think that maybe it's no longer in a bear trend. It might now be either in a trading range or a bull trend. So they get out, and if there's a strong reversal down, they'll look to sell again. Here, 3 bull bars, 1 pretty good. They might not sell here. Here, a micro double top, micro triple top, but a bull bar, they might not sell there. And as I said, sometimes you have to back up and ignore the minor reversals and just look at the top of the major reversals down and call that a major lower high. Because a lot of times the market will make what appears to be fairly major new legs down, but the market goes above it and does not go above more significant lower highs. It's a different style of trading. Some traders prefer to use the very wide stops and not get stopped out unless the market clearly is no longer in a bear trend. Other traders tend to get out above major tops that are not quite as major, and then if the bear trend resumes, they'll sell again. Broad bear channel. Most traders are not going to let their stops get hit. This is a very strong reversal up. It's a minor reversal. It's a reversal in a bear channel. Maybe it's major. Some traders might call it a double bottom or a lower low major trend reversal. I'm not convinced that it's a major reversal. I would assume that this is fairly minor after this strong a sell-off. However, this is a very strong minor reversal up, and therefore traders will pay attention to the next reversal up, because after a very strong minor reversal, the next reversal is often major, and especially if there are other reasons to buy. Here we have a microdouble bottom and a nested wedge. 3 reversals up, 1, 2, 3, and then 1, 2, 3. When there are minor reversals and then sell-offs that are not particularly strong, traders look at every one of these minor reversals down as minor lower highs. And rather than buying on a stop above those, bears will sell with limit orders at that high and scale in higher and keep a stop above the most recent major high. When the market goes above minor highs, like above this or above that or above this, bears assume the rally will fail and the bear trend will resume. Therefore, yes, it's rallying for 30 or 40 bars, but it's still more likely a bull leg in a trading range or a broad bear channel than the start of a bull trend, even though there's a higher low major trend reversal. Remember, most major trend reversals, 60% of them, do not lead to bull trends. They lead to either a trading range or a resumption of the bear trend. Again, some bears would sell above this high, arguing maybe this is not all that major, it's still part of a fairly tight channel here, and maybe this is the major lower high, and these are minor lower highs. So these bears would sell with a limit order here and put a stop above what they believe is a much more major lower high. At this point, the market has a wedge, and it has a nested wedge because there's a second wedge here. The third leg down subdivides into a wedge. Because it's a bear trend, even though it's sideways for a lot of the time, a lot of traders prefer only to look for the shorts. We have a strong breakout to a new low. The market's clearly always in short at somewhere in here. They'll look at these pullbacks as simply deep pullbacks in a broad bear channel, as long as the market continues to make lower highs. The market, when it's in a broad bear channel, will often be always in long. Like, for example, by the close of this bar, it's always in long. Chances are it'll either go sideways for a second leg or up. And the same here. The market is probably always in long, maybe by the close of this bar, by the close of that bar. Yet, always in long, it's still made a new low. Always in long, strong breakout, but look to the left. It's not above all the bars to the left. And therefore, in fact, it could be a second leg trap. 1, pullback 2, or 1, pullback to a new low, and then 2. A two-legged correction, 1, pullback 2, where the pullback goes below the low of the first leg. Since the past couple of days have been in a broad bear channel, the bears will keep selling every reversal down from what they believe is a minor trend reversal. So it rallies, they'll sell, stop up here. Rallies, they'll sell, stop up here or here. And we have a double top. You can call it a wedge, 1, 2, 3, where 2 and 3 form a double top. Traders going to look to sell reversals down. Strong rally, but not above truly major lower highs, they'll sell. Here, strong rally above what some traders would consider a major lower high, but a bear bar, it's not above bigger lower highs. Traders will assume it's a bull leg in a trading range, and they'll sell a reversal down. The traders who sell, some traders will scalp, thinking that maybe it'll stay in a trading range. And if they do, they should always be trading for at least the minimum scalp, which is 1 point in the E-mini, and they want to get out with at least twice their actual risk, unless there's a high probability short. And shorting in a trading range like this is not all that high probability. So if a trader sells below that bear bar, his actual risk, this pullback got just up to that bar, so his actual risk is a little bit above that yellow line, and 2 times actual risk is here. And you can see what happened when it got down here. It rallied. because bulls were buying what they thought was a higher low major trend reversal, and bears were buying back their shorts at around 2 times actual risk. The bears will take profits once they reach their scalp goal or on a reversal up, even if it's not quite at their profit target. They sell here, 2 legs down, maybe a wedge bull flag, 1, 2, 3. They'll buy on a reversal up, especially a second reversal up, 1, pull back, and then 2. The bears who are selling here, a second entry short, 1, 2, are selling because they believe it's in a broad bear channel. They will look to take profits at the prior low or on a reversal up, like here. The bears selling here, their actual risk is small, but they may want to take profits at some kind of a measured move target, like here. We have a head and shoulders top. We don't know what's to the left, but it could be a head and shoulders top and a bull trend. It could be a head and shoulders top bear flag and a bear trend. In any case, they'll look for a measured move down based upon the height of that lower high. The bulls were trying to get a double bottom, and it failed. So instead of breaking above the neckline and rallying for a measured move up, the bears will look for a measured move down. Test of the low close. Remember, you have sell to close bears selling every bear close. The market reversed up. There's support at the test of the low close. There's support at the bottom of the buy signal bar and the bottom of the buy entry bar. Those are also support areas, and that is an area where the bears will look to take profits, or at the new low. Bottom of a channel. Some bears will take profits with a limit order at that trend channel line, or on a reversal up, especially a second reversal up, 1, pull back 2, especially at a new low. I mentioned second leg traps. I want to talk more about it here. A broad bear channel is similar to a trading range that's sloped downward, and therefore it has a lot of characteristics of trading ranges. And one of the common things in a trading range is the market has a lot of two-legged moves, and the second leg is often very strong, leading traders to believe that it's on the verge of breaking out into a trend. But most trend attempts fail when the market's in a trading range and reverse. And that strong second leg simply traps traders into buying too high. In a broad bear channel, you can get second leg traps up or down. For example, we have a rally, and then we have a second leg up to a new high, and it's an even stronger rally. It's a breakout above that high, consecutive bull bars. However, you look to the left, and we're still below the top of what could be a bear trend at this point, and therefore this might be a trap. It's strong enough up so that we might get a second leg up or sideways, 1 pullback 2, and we did. But you got to be careful if you're buying up here. You have to use a wide stop, and you probably have to scale in, because instead of this being the start of a bull trend, it could be the end of a two-legged correction in a trading range or in a bear trend. And you can see right here, the market tested the top of that strong bull breakout and failed, and the bulls finally gave up. And the bears knew the bulls would give up, and the bears sold as well. This is an example of two legs down in a bear trend. We gapped down, we rallied, and we sold off very strongly. Bears are hoping that the market will collapse and accelerate downward, but it's still a broad bear channel, which is similar to a trading range, and therefore you can get two legs down that trap traders into thinking the bear trend is becoming stronger. Sell the closed bears might sell here, but if they're quick thinking, they'll be disappointed by the doji bar, and then certainly disappointed by the bull bar that followed here, and they'll get out, fearful that this is simply a second leg trap at the bottom of a bear channel. The bears who sold that close, 3 consecutive bear closes, are disappointed by the next 3 bars, and a lot of them got out. And if they did not get out on the test of that low close over here, or anywhere in this tight range, they gave up here. You can see this bull breakout starting to reverse the sell-off, and this represents bears buying back their shorts, and it also represents bulls buying, expecting a leg up in a broad bear channel. and the final bears gave up here. If they did not give up here, they gave up here. And this became a two-legged trap going up in the bear channel. Leg 1, pullback 2, or leg 1, pullback 2, where the pullback is below the bottom of the first leg up. This is very similar to that, and they're close to one another in proximity, so they're probably part of the same process. This is the first leg, pullback, second leg, trapping traders into buying too high. But look to the left, you're still within a bear channel or a trading range, and you do not want to be buying too high in a broad bear channel or in a trading range. Traders who buy up here are probably going to get trapped. Trading ranges often have two legs up and down, and broad bear channels often have two legs up and down. And a lot of times the legs up last a lot of bars and are strong enough to make the market always in long, at least on a 5-minute chart. This is several days on the 5-minute chart. Nobody's going to be trading a chart that looks like this. This is basically a line chart. It's a bar chart where the bars are compressed together to show many hundreds of bars. If you're going to be trading this many days, you're not going to be using the 5-minute chart to do it. You'll try using a 15-minute or 60-minute chart. In any case, if you were simply looking at the 5-minute chart, the rally up would be strong enough to make the market always in long, and the same right here. This might be 30 or 40 bars up. And if we were only looking at these 100 bars, this rally would be strong enough to make that chart always in long. Leg 1, strong enough, so we'll probably get a second leg sideways to up. We have it. Once the market's always in long, you only have about a 40% chance of a major reversal back down. But when it comes, it often is fast. Here we gapped down and covered a lot of points simply on the open of the day. This is, you can argue, a higher high major trend reversal. We have a bull trend lasting a couple of days, a bear breakout, and then a higher high. It's also a wedge top, 1, 2, 3, and a lower high in a broad bear channel. But if you're simply trading a 5-minute chart, you're only looking at these 2 days at this point. You have to be careful that this might be a higher high major trend reversal. Any major trend reversal has only a 40% chance of actually leading to a major reversal. So bull trend, 40% chance of becoming a bear trend. But when it happens, it can happen pretty quickly. If the bears get out for any reason during this stretch where the market was always in long, they have to be looking to sell again if they're looking back at the past several days and seeing that the market's in a broad bear channel. It's a higher high major trend reversal, which is a type of double top. So we have a double top, we have a neckline. The goal for the bears is at least a measured move down. A similar thing here. We have a double top, neckline. Goal for the bears is a measured move down. I always look at the measured move based upon the lower of the two highs as the first target. And if it goes below that, then I'll look at a measured move based upon the higher of the two highs. Traders are always paying attention to how far a breakout goes below a breakout point because they expect the next breakout to be similar. And once you've looked at a number of these breakouts and compared them to breakout points, you have an idea of how far the next breakout will probably go before the bulls come in and start to buy. Strong breakout below a prior low. This is the breakout point, and that's the breakout. And how far did this low go below that low? Here, 26 ticks. This low, this breakout, went 62 ticks below that breakout point. And then you can see other breakouts, how big they are. Bulls like to buy below prior lows, and they'll pay attention to how far lows have been below breakout points to get an idea of where they should buy. Should they buy exactly at the prior low, or should they look to buy a certain number of ticks below that prior low? This breakout point, 26 below the breakout, 24 tick breakout here. Traders see this reversing up 26 ticks below that. We'll expect that if we get around 26 ticks below here, we'll probably reverse up. And therefore, bulls will look to place a limit order to buy 20 ticks, 25 ticks, 26 ticks below that low, expecting a similar reversal. If you're taking limit order trades against a trend, first of all, you should only do it if you're a very experienced trader. And next, usually it's better to use a wider stop and then scale in, which means you should be trading very small. A lot of the bulls who buy below a prior low will take profits at the prior low or somewhere above that prior low. Some traders will buy with a limit order at that low and then scale in more lower and get out break even at their original buy and then with a profit on their lower entry. Or they can take profits on a reversal down. Let's say a trader did not buy at that low and instead bought about 20 ticks below that low, and they expect the market to reverse up and retrace about half of the most recent bear leg. Therefore, they'll take profits in that general area, especially on a reversal down. Or they'll see a reversal up like this and think it's strong enough to get a second leg up. And because the second leg up is still probably a bear leg in a bear channel or in a trading range, they'll look to sell at that high or on a reversal down from that high. Market's making lower highs, lower lows, therefore a bear channel. Some traders will sell the lower high. They want to be selling somewhere in the middle third or the upper half of the most recent leg down. They know the last bear breakout was 26 ticks below the breakout point. So where will the bears take profits if they sell here? Well, they expect a new low, and therefore they're not going to be taking profits here. They want to be taking profits at least at this low, or they'll decide that maybe it's going to go lower. This breakout went 26 ticks below that. Maybe the breakout below will be 10, 20 ticks below here. So some of them will try to take profits a little bit lower than that low. Maybe take profits half the distance of the size of that breakout. This is 26 ticks. Maybe take profits 13 ticks below this low or on the reversal up. Big gap down. When the market is forming gaps, bears are more likely to swing and bulls are more likely to wait to buy. Well, you can see we gap down here below that low. Will bulls immediately buy on the open, betting that the gap will close? Some would do that. However, others would stop buying and wait until the market is entering a stairs pattern again. If you're buying in a bear trend, you want to see reversals right after the market makes a new low, and you want the pullbacks to go at least halfway up the most recent bear leg. And at times when the bear trend is particularly strong, it's usually better not to buy until the bear trend starts to weaken again. This pullback slightly overlaps this breakout point, and it almost touches this breakout point exactly. Therefore, this high, which is leading to a reversal down, could be a fairly major high, and it's testing all of these lows and not getting much above them. These lows are therefore major. Therefore, this line is important. It's important resistance, and it often leads to a measured move down. So we know this line is important. It was support, and then it became resistance. I look to the left to find a major lower high, which is right here, and this point is major. It led to a strong breakout to a new low. This line is major. When you have two major points, they often create a third major point, a measured move down. If it falls below a measured move based upon that, which it did, traders will then look to the left for another major point and look for a measured move based upon that. The entire bear trend, we're breaking out below, maybe it'll fall for a measured move down. Whenever you get a breakout and then a pullback that goes above the breakout point, I call that a stairs pattern. So the market is stair stepping down. The pullbacks are going above the breakout points. That means that bulls can make money buying in a bear trend. It's still always better to be selling in a bear trend, but the bulls can make money. Bears who sell reversals down from the middle of the most recent bear leg will look to take profits around the prior low. betting that the market will again pull back to the middle of the current bear leg. The bulls see what's going on as well. They see rallies going above breakout points, and they'll buy for a scalp somewhere back up to the middle of the most recent bear leg. Sometimes they'll buy at the prior low and scale in lower and just scalp out when it gets back to the breakout point. Other times they'll buy a reversal up and exit somewhere in the middle of the most recent bear leg. Traders are always drawing lines. When the market reverses down and then reverses down a second time, they can draw a line, and they see what the market does when it gets to that line. If it stalls, they'll look to sell a reversal down. Market reverse down again, draw a line, and you can see traders sold around that line. Reverse down, you can draw a new line, and traders just keep doing that all day long. The market reverse down a second time, draw a line. And when above the line, reverse down, you can draw a new line using that new high. We then reverse down strongly here, go to the left, you can use this high or that high, draw a new line using this high, and watch what happens when the market gets there. A lot of traders will look to sell at that line or on reversal down from that line. It's a channel. All trends are in channels, and traders also draw lines using lows. The market reversed up here, they draw a line and see what happens if the market gets to that line. It broke below it, reversed up. You can now draw another line from this low and that reversal, and you get this. And you wait to see what happens here. You look for a reversal up. We have two reversals, 1, 2. You can draw a line and see what happens when the market gets near that line. Look to buy a reversal up, and you just keep doing that all the time. When the market's in a channel, especially one with fairly broad swings, 75% of the time, when it's trying to break above the top or below the bottom of the channel, the breakout attempts will fail, and the market will have at least a minor reversal. And therefore, whenever the market goes above the line, traders sell a reversal down. Above the line, sell. Above the line, sell. Above the line, sell. And the opposite true at the bottom. When it breaks below a line, traders look to buy a reversal up. When it's in a bear trend, especially a fairly steep trend, traders will focus more on selling. However, as long as the reversals up are fairly strong, bulls will buy as well. When bulls are buying in a bear trend, first of all, only experienced traders should be doing that. They'll be using wide stops and they'll often scale in. Some bulls buy with a limit order at the prior low. They see the market selling off, they'll place a limit order to buy at this low, and they'll get filled right here. Where should their stop be? Well, maybe a measured move down from the height of this leg. The bulls are thinking that we have a rally, we have a pullback, maybe we'll get a double bottom and break above the neckline for a measured move up. On the other hand, the bears will want a breakout below and a measured move down, and therefore a lot of the bulls who are going to scale in will put a stop just below a measured move down. A leg down, some bulls will buy at that low with a limit order and put a stop down here, and they're willing to scale in more if the market falls a little bit further. Same thing here. The market reversed up. Theoretically, it could have formed a double bottom here and rallied above the neckline of the double bottom for a measured move up. If instead it falls, the bears will look for a measured move down. It's in a stairs pattern, so the bulls assume that it will not fall for the measured move down, and instead that there'll be buyers at or just below that low. So they'll buy with a limit order at that low, get filled here, and put a stop a little bit below the measured move target. Same thing. Here you can see it got very close to the stop, yet it's still reversed up. If you're scalping longs in a bull trend, you should always go for at least a minimum scalp. In the E-mini, a minimum scalp is 1 point, and you should also be going for at least twice your actual risk. If a trade is high probability, you can scalp out at 1 times your actual risk. Some bulls will take profits at a fixed number of ticks, like 4 points, 16 ticks, buying here, getting out there. Others will take profits at a resistance level. It's a bear trend, so they expect a lower high. So if they buy here, they expect resistance at about a 50% pullback from the height of the bear leg, and they'll get out here, even though it's a smaller profit than they may have wanted. Others prefer to hold in case it becomes a bull trend, knowing that it probably will not. They buy here, and they'll look to sell on a reversal down somewhere in the middle third of the most recent bear leg. Let's say a bull bought here, whether or not he scaled in here, he might try to get out at his original entry price. After such a big sell-off, he's now concerned that it's not going to rally very much. And let's say it did not get above his entry price. So this high did not get above that low. So a bull who bought here, disappointed by this, tries to get out break even. It gets right near his price, but not above it. He'll then exit with a loss on a reversal down. A lot of experienced traders will buy small and they'll scale in lower and use a wide stop. By scaling in, you're increasing your probability, but anytime you improve your probability on a trade, because of the trader's equation, you have to reduce your risk reward. And that usually means you're increasing your risk and reducing your profit. Again, you should always be trading small enough so that your risk is not bigger than it is on any other trade. A bull buying here might trade very small. He knows where his stop is. He'll maybe use a measured move down just below the measured move down, this black line, and maybe he'll scale in at fixed intervals, like 5 points below his entry price, 5 points, 5 points, and then get out of the entire position if it hits the stop. If you're scaling in, you have to be trading very small. You're scaling in for one reason, to increase the chances of making money. That means you're trying to increase your probability, and you have to accept greater risk, a greater position size, stop further away. That means you're getting worse risk reward as the price that you're paying to get the higher probability of making money. If a trader does buy here and he's willing to scale in, he can also scale in at a 50% move down to his stop. So he buys here and he knows where his stop is, maybe buy more halfway down to the stop. Other traders, in fact, this is what I like to do, is they'll buy here and then wait for a reversal up, especially if there's a pretty good bull bar, and then buy more above that bull bar, betting that the market will come back to their entry price and they can get out break even on their original buy and with a profit on their lower buy. And as I said, if it starts to turn down without filling your limit order here, you get out as it turns down, a small loss on your first buy and a bigger profit on your lower buy. There's a second reason why traders sometimes scale in. One, obviously, is to make money, and the second is to avoid a loss. So if they buy and they're disappointed by the extent of the sell-off, they may buy more lower, and then to avoid a loss, try to get out in between their two entry prices. One thing that I like to do, and some traders do as well, is instead of taking a buy at that low, they know some scale-in traders will do that and scale in more lower, especially above a good bull bar. We cannot see this bar, so we don't know if it has a strong bull body. But if it does, a lot of bulls will buy more above that strong bull bar. A lot of times what I'll do is not take the first entry, wait for the strong bull bar, and buy above the bull bar, expecting it to come back to that first entry. And if it gets near there and starts to reverse down, you get out on the reversal down. I want to show a close-up of what I was talking about. This little blue box I'm going to expand on the next slide. Remember I said that some bulls will buy with a limit order here and then buy more above a strong bull bar, expecting the market to get back to their original entry price. So on the next slide, let's take a look at just this blue box. Okay, this is the slide that I just showed you. And this is a close-up of it. So bulls bought here, which is a test of that low right there. And then some bulls will buy more above a bull bar, either above this bull bar or above that bull bar, expecting the market to get back here where they can get out, break even on their first entry, and with a profit on their lower entry. Other traders do not take this entry if they think the trend is strong, and they'll simply look to buy where the scale end bulls will buy, and then take profits when it gets up to where the scale end bulls will get out. If it gets there and reverses down, especially with a decent bear bar, they'll get out below the low of that bar right here. So those traders will buy here or here, and then get out here with a profit. This is the stop, which is below the measured move target. Because it's a strong bear bar, even though there's a very strong rally, there's a bear bar closing on its low, and it's a breakout test. It's testing that breakout point over there to the left, which is this low, and it's reversing down. Traders know that when you have a strong rally in a broad bear channel or a trading range, it could very well be a second leg trap. We have a first leg up, and then sideways, and then a second leg up. Unless it breaks above all the bars to the left, there's a reasonable chance, maybe 50-50 chance, it's a second leg trap, trapping traders into holding long, hoping for a bull trend, or buying high, hoping for a bull trend. But more likely, it's a second leg up in a broad bear channel or in a trading range. And if it starts to reverse down, you have to get out of longs, because bears will be selling. If you're buying new lows in a bear trend, you have to get out if the bear breakout becomes too big. Let's say you bought at that low, which I would not do when the channel down is as strong as this is. I would not take that buy. But some bulls will buy because they'll see, oh, we got a strong breakout here. They made money buying at that low. Same here, strong breakout to new low. They made money buying at that low and lower. And therefore, if we have a strong breakout again, they can buy at the low and buy more lower and either avoid a loss or make a profit if they scale in and use wide stops. And that's an important if. That's one of the reasons why this strategy is bad for beginners, because they will not manage the trade correctly. Experienced traders will do it knowing that they'll either make a profit, or if they scale in and manage their trade well, they'll at least be able to avoid a loss. Let's say you buy with a limit order at that low, and instead of using the height of the trading range for a stop, a measured move down, some traders might use 2 times the size of the biggest prior breakout. Here's a low, here's the breakout, here's a breakout below that low. The biggest prior breakout was 26 ticks. This low went 26 ticks below that low. And to give themselves a buffer, they might place a stop at 2 times that down here. This is a 26 tick breakout, and maybe they'll put a stop at a 52 tick breakout, thinking that the breakout probably will be similar to these two, but they certainly don't want to hold long if it's more than twice as big as these two. Here, this breakout was 62 ticks below that low. You always have to have a reason to get out. And as long as the reason is reasonable, it makes sense, then it's okay to take the loss. You can always buy on the reversal up, like I said. A lot of traders will buy above a bull bar, knowing that limit order bulls will buy there and buy more above the bull bar. So if you did get stopped out, you can immediately buy again above a bull bar, expecting the market to get back up there. And then you can exit on a test of the prior low or on a reversal down. For example, if you bought at this low and exited on a stop at 52 ticks, you lose 52 ticks. And then if you held and exited on a reversal down, you'd make 45 ticks on this trade. So you lose 52, you make 45, and you'd have a net loss of 7 ticks. Many traders like to enter on second reversals, so we reversed up, the bear trend tried to resume, and we're trying to reverse up a second time. So we have a small micro double bottom. That is a higher probability buy. Minimum scalp in the E-mini, 4 ticks, 1 point. Minimum reward is 1 to 2 times the actual risk, and if the probability is high, 60% or better, you can exit at 1 times that actual risk, as long as you're going for at least a 4-tick, 1-point scalp. Let's say you bought on the reversal up, although you can't see this because I don't have it zoomed in. The actual risk was 4 ticks, 2 times the actual risk was 8 ticks, and the market went high enough up for you to get your 8-tick scalp. If you're looking at a channel where the rallies are 10 or 20 points tall, and 2 times your actual risk is only 2 points, that's probably too small a profit and you should be going for more money. For example, you might double it and go for a profit of 4 or 5 points and get out here. Or you can get out at a 50% pullback of the most recent bear leg. So bear leg, 50% pullback, get out there. Or you can look at this strong leg up. Maybe the market will have a second leg up, and then you can get out at this high or on a reversal down. Bear trends need lower highs, especially major lower highs. If the market goes above a major lower high, then it's either in a bull trend or a trading range. It's no longer in a bear trend, and therefore you do not want to be holding short. You get out on a stop above a major lower high. Whenever the market's in a channel or a trading range, second leg traps are common. The market has a very strong second leg, and you think that the market's converting from a channel into a trend, but it traps traders into buying too high if it's a second leg trap up, or selling too low if it's a strong second leg down. Because the reversals up go for a lot of bars and cover a lot of points, bulls can buy below bars and make money. More experienced traders will use wide stops and scale in. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the 4th of 5 videos on trading broad bear channels. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the 5th of 5 videos on trading broad bear channels. I want to talk about 2 points in this video. First, I want to talk about the sell zones. It's a broad bear channel, and traders should be looking to sell pullbacks, and they should be especially looking to sell a pullback that is around 50% of the most recent leg down. This is the 15-minute chart. It's a broad bear channel. The reversals up last a lot of bars. Whenever you get a strong sell-off and then an attempt to reverse back up, the bears are going to look to sell somewhere in the middle third of the most recent leg down. We have a bear breakout. This red box is the middle third. This is the sell zone. This is where the bears will be looking to sell. Some will place a limit order to sell at a 50% pullback from the high to the low. Others will sell on a reversal down. For example, we have a bear bar here. We have a bear bar here. Some traders prefer to sell using a stop below the bear bar, somewhere in the middle third of the most recent leg down. They'll put a stop above. Minimum goal is a new low. The risk is equal to the reward if you sell the 50% pullback. But the market's in a bear trend, and therefore the probability is higher that you'll get down to the reward before you get up to the stop. Therefore, the trader's equation is good. Broad bear channels spend a lot of time going sideways. At times when it looks like it's more in a trading range than still in a channel, traders will look to sell in the top third instead of the middle third. They can sell with limit orders above prior highs, or they can sell with a limit order at a fixed percentage, like a 50 to 60% retracement of the bear leg. Here we have a bear leg. It's a trading range. This is about a 50 or 60% retracement of the bear leg. Therefore, about a 60 or 70% rally in the trading range. Most traders should be looking to sell with stops. Therefore, when the market's up in the upper third and starts to reverse down, traders can sell with a stop order below the low of the prior bar. This is not ideal because the sell signal bar has a bull body right here, but it's 2 legs up, 1 pullback 2, inside a bigger 2-legged pattern, 1 pullback leg 2, and therefore a reasonable sell with a stop above the top of the most recent major lower high, either here, above here, or up here. It's a bear trend. Bear trends are either breakouts, tight channels, or broad channels. This is a broad channel. It's a bear trend. It's the weakest type of bear trend, but it's a bear trend. And therefore, you can sell at any time for any reason as long as you use an appropriate stop. The stop above the most recent major lower high. Strong breakout to a new low. This high is major. As long as any rally stays below this high, the bears can argue that the market's either in a trading range or still in a bear trend. If it goes above that high, then it's no longer a bear trend. Then it's either a trading range or a bull trend. And if you're selling because it's a bear trend and it goes above this high, you know it's not a bear trend. Of course you want to get out, and therefore it's reasonable to get out if your stop is hit. You can sell at any time, including on a breakout to new low. You can place a stop order to sell just below this low. You can place a stop order to sell just below this low or any low. However, because it's a broad channel, the pullbacks are deep, they retrace a lot of the prior bear leg, you usually can get a much better entry price than selling at that low by simply waiting for a rally above that low. Every time there's a strong breakout to a new low, it begins with a major lower high, and after each new strong breakout to a new low, traders will put their stop above the most recent major lower high. Let's say you sold up here, and you're holding short, and then we get another breakout to a new low. This is the most recent major high, so it doesn't matter where you sold, you're going to have your stop above this most recent major lower high. Similar to a trading range, because so much of the time is within a trading range, it's easier to make money if you wait to sell rallies than to sell breakouts. In general, most traders do not sell breakouts to new lows. The only traders who take these sells, well, for the most part, the only traders selling down here are bulls, and they have protective stops below that low, and they're getting stopped out. A bull might buy this as a higher low, major trend reversal, and then once we get this rally, he might put a stop below here or below here, and then he gets stopped out. Therefore, you have bulls selling at the new lows. They're getting stopped out, and the bears are not selling down here. The bears are buying down here. They're buying back their shorts from selling higher. Instead of selling at new lows, the bears are using prior lows to take profits. They want to take profits somewhere at or below the prior low. If you sell here, you might want to take a profit at that low or some fixed number of points below it or at some other resistance like the bottom of a channel. And that's true with any of these rallies. Bears are selling rallies and then taking profits somewhere below the most recent prior low. It's reasonable to take profits at the low with a limit order or on a reversal up from below the low. For example, here, if a bear sold here, he might take profits, partial profits, or full profits here, and then he'll take more profits or exit completely on a reversal up, especially a micro double bottom and a decent buy signal bar. The bulls know the bears are buying, and if the bears are buying, the market's going to go up, not down, and the bulls therefore buy exactly where the bears are getting out, betting that there'll be a reversal up that will go up far enough for the bulls to make a profit. Remember, a broad bear channel is just a trading range that's sloped downward. Therefore, the bears expect rallies, and they expect the rallies to last a lot of bars, and sometimes the rallies can even make the market always in long. However, as long as any rally stays below the most recent major lower high, it's still in a bear trend. At times when the market is mostly sideways, if bears still believe it's in either a trading range or a broad bear channel, some bears will wait to sell close to the prior high, and they might sell with a limit order or on a stop order on a reversal down. These are all types of double tops. Double top with this high and that high, or this high and that high. We have a small double top here, double top bear flag, bear trend, double top, sell the reversal down, and then this high and this high, or this high and that high, double top. The bears believe that it's in a bear trend. They're expecting every reversal up to fail. Therefore, if there's a big bull trend bar in the middle third or top third of the most recent sell-off, bears will sell the close, betting that the bull breakout will fail and that the bear trend will resume. Remember, the bears are looking to sell rallies, up somewhere in the middle third or even the top third, somewhere in the top half of the most recent bear leg. Therefore, the bears are not selling down here, they're selling up there. There is then a lack of sellers here, and the reversal up can be fairly sharp. You get a buy vacuum up to the resistance area, up to the sell zone, and it can be fairly sharp, and the market can even become always in long. Here we have a series of bull bars, and the market probably is always in long for most traders here. Here, a good bull breakout above a bear flag, market might be always in long for a lot of traders. The bulls think they won, but the market rallies into the sell zone. The bears are going to bet against the bulls. They'll bet that the bull breakouts will fail and that the market will continue down to a new low. So the bears will sell strong bull bars or reversals down after a strong rally, betting that the rally is minor and that it will lead to a new low. When the market gets up into the sell zone, the upper two-thirds, the upper half, the bears overwhelm the bulls and the bulls take profits. Most of the bulls are scalping because they know the market's in a bear trend. The market then goes back down. The bulls are selling out of their longs. The bears are selling into their shorts. Whenever the market's in a broad bear channel, there are many times when you have two choices for stops and both are reasonable. A major lower high, we have a double top and a breakout to a new low. Reasonable location for a stop. Strong breakout to new low, followed by a reasonably strong reversal up. This is a major lower high, and the same here. Strong breakout to new low, following a reasonable reversal up. Now, is this a major lower high? We have a decent reversal up. We have a sell-off and another sell-off, but it lacks consecutive big bear bars, so not a strong bear reversal, and it did not go to a new low. The bears can argue that it's a strong enough reversal down so that they do not want the rally to go above this high, but it's really a minor lower high. It did not break strongly to a new low, did not have consecutive big bear bars. Therefore, if it goes above this high, some bears might get out and sell more on a reversal down, but it's also reasonable to use this high for the stop, put a stop just above this high, because this clearly is a major lower high. If you do use the tighter stop, you'll lose less money, but you'll lose more often. If you use the wider stop, when it does get hit, you'll lose more money, but you'll lose less often. If you take the wider stop or the tighter stop on 10 different trades, your total profit will be about the same. Therefore, if you take any reasonable stop, it doesn't matter if one is further away, the profit result will be about the same. Bears using the tighter stop will sell on the reversal down. Here is the end of the day, and you might wait for a big bear bar and a follow-through close bar and then sell the close. "50% pullbacks are always very important because the math favors a resumption of the trend. Probability favors the trend continuing. We're in a bear channel. We're forming lower highs and lower lows. It's a weak trend. It spends a lot of time going sideways, and sometimes it reverses up strongly enough for the market to become always in long. However, because it's a bear trend, by definition, it means it's more likely to go down than up. Therefore, the probability favors a continued series of new lows rather than the market going above major lower highs. If the market sells off and rallies to about 50%, the risk for the bears is to above here, the reward is to down here. Risk equals reward. But it's a bear trend. The probability favors a new low, and therefore, even though the risk is equal to the reward, the probability makes it better to look to sell. It's a positive trader's equation. Bear leg, traders will sell a 50% pullback. Some will sell with a limit order, others will sell with a stop on the reversal down. If you sell with a limit order, your profit target is a new low, and your risk is just above that high. So the reward is equal to the risk, or just about equal to the risk, but you're in a bear trend, so the probability favors the bears. Therefore, the trader's equation is good for taking that short. If you believe it's in a bear trend, then you believe there's a 60% chance that the market is going to go lower. And the result is a good trader's equation. Even though the reward is small relative to risk, it equals the risk. The probability more than offsets the weak risk reward. Stop of the top of the most recent major lower high. And then take profits either at the prior low or on a reversal up. A new bear leg, traders will sell, or many traders will sell with a limit order 50% of the way up, betting that the market's in a bear trend and therefore it's probably going to a new low before it gets above a major lower high. And they're correct. Therefore, you can sell and go for a reward equal to your risk, knowing that the 60% probability of reaching your target before hitting your stop makes the trader's equation positive. Many traders prefer to enter with stop orders, so they'll enter below the prior bar on a reversal down, especially if it has a bear body, like here or here. And then take partial or full profits at the prior low. Or on a reversal up, here or here. Or at the end of the session. This is the end of the day. And if you sold up here or anywhere in here, and you're at the end of the session, and you do not want to hold overnight, you just get out right before the close. Strong breakout to new low. Odds are any pullback will get back to the low before it gets above the high, and therefore some traders will sell with a limit order at a 50% retracement of this sell-off, or with a stop on a reversal down, especially below a bear bar. 5-minute Globex chart. This is 10 days in a broad bear channel. On the 60-minute chart, it's a fairly tight bear channel. The pullbacks are sometimes 20 points tall, and a 20-point pullback means a fairly broad channel on the 5-minute chart. Every broad bear channel is going to have trading ranges, lots of trading ranges. And some of them are nested within bigger trading ranges. Trading range typically is breakout mode. Breakout mode means the probability of a reversal up is equal to the probability of trend resumption down. However, the market's in a fairly tight bear channel on a higher time frame chart, and that means even if you do get a bull breakout, the odds are the market's going to continue lower. Every trading range in a bear trend has a bottoming pattern, and it also has a continuation pattern, bear flag. Every trading range in a bear trend is a bear flag, but there's always a bottom within it as well. We have a trading range here, and it was part of a triangle. This whole area is a trading range as well, and it's a lower high major trend reversal, head and shoulders top. Now we have an expanding triangle bottom, 2 legs down, 1 pullback 2. The bulls are hoping for a reversal up. Strong enough reversal, second leg up, likely, maybe this, maybe that. And that was the end of it. So instead of a bull trend, it became a trading range and a bear flag. 3 pushes down, so a wedge bottom. Bear trend, constantly forming trading ranges, and every trading range has a buy setup. Another wedge, double bottom, higher low, major trend reversal, bear trend, strong bull breakout to a higher low, and this higher low is a double bottom. The bulls got a swing up, but not much of a bull trend. It lasted about a day or so. Always in long, but still in a broad bear channel. Another attempt at a higher low, major trend reversal, bear trend, bull breakout, two legs down to a higher low, and it became another bear flag. Whenever you see any kind of a pattern, there are often multiple ways to label it, but never lose sight of the goal. Bulls are looking for a bottom pattern. It doesn't matter if you call it a wedge, a head and shoulders bottom, a double bottom. As long as you see the bottom attempt, that's all that's important. Some of these bottoms led to rallies that lasted for hours, yet they formed major lower highs. When the bottom fails, for example, we have a wedge bottom here, 1, 2, 3, and then a double bottom higher low major trend reversal. But look at this. It failed. The bulls who bought put a stop below here or here, and they got stopped out. And the bulls give up, and that results in sometimes a fairly sharp breakout below the prior low. Bulls tried to get a reversal. They had a triangle bottom. They were hoping for a reversal up, and they gave up. Bulls tried to get a double bottom or triangle, high or low, after a strong bear breakout. They gave up. Bulls gave up. Bulls gave up. Despite all of these bottoms, the bulls gave up. Whenever there's a breakout, the bears are going to look for some kind of a measured move down. In a bear trend, every trading range is a bear flag or it contains a bear flag. Wedge bear flag, a two-legged rally, so a big low two short bear flag, head and shoulders top bear flag, head and shoulders top, low two, two legs up, one pullback two, so a low two bear flag and lower high major trend reversal. We have a bull breakout of a triangle that failed. Double top, lower high double top. A wedge rally, so a wedge rally to a double top. All are bear flags, and the odds are the market is going to resume down. A large low two, leg one, pullback leg two, and leg two subdivided into a wedge rally. A double top, lower high. It's a double top bear flag where the second high is below the first. The market broke below the neckline and fell for more than a measured move. Head and shoulders top bear flag. Whenever the market's in a trading range, the probability is close to 50-50 for a bull breakout or a bear breakout. But as long as the market's making a series of lower highs, the probability is always slightly higher that there'll be a successful bear breakout below the bottom of the trading range. Consequently, it's easier for the bears to make money. On a higher time frame chart, as I said, this is a fairly tight channel on the 60-minute chart. That tells you that on the 60-minute chart, it's certainly going to be easier making money selling because you're in a fairly tight channel. This is the 5-minute chart. It's a broad channel. This is many days on the 5-minute chart. A day trader is going to trade each day as it develops. They're not going to be paying attention to all of these bars. They might be aware of the market being in a bear channel, but they know that the market is often always in long in a broad bear channel. And if you're a day trader, you're going to be buying during this rally. Broad bear channel, and now we're accelerating downward and we're getting a bear breakout below the bear channel. Whenever you have a bear breakout below a bear channel, 75% chance the breakout's going to fail and the market will resume up and test the top of the channel. Whenever I see a strong bear breakout below a bear channel, I look at the highest time frame that shows the broad bear channel. And on that time frame, the bear breakout has a 75% chance of failing and beginning to reverse within 5 bars. This is a 60-minute chart of this 5-minute chart. It fell for about 5 or 6 bars and then reversed. Only a 25% chance that a breakout below a bear channel will result in an even stronger bear trend. 75% chance it's going to fail and reverse back up to at least the top of the channel. Here, I have a 60-minute chart. I could have put a 90-minute chart up and it would have been the same thing, and the reversal would have occurred after about 4 or 5 bars. We have a breakout and we have a reversal attempt, and it went a little bit above that low, but not much. So there's some overlap. Instead of a gap between this high and that low, I call it a negative gap. But negative gaps usually also lead to measured move projections. And therefore you can look at the midpoint of the overlap between this pullback and this breakout point and project a measured move down. And you can see the bears took profits at around the measured move target. Very strong bear breakout. And if you're trading the 5-minute chart, you're going to trade it like you would any breakout, and you'd sell for any reason and hold for a swing down. A breakout is a spike, and then we have a channel. So this is a spike and channel bear trend. No channel lasts forever, and channels usually ultimately evolve into trading ranges. There's only a 25% chance of a successful bear breakout and then a strong sell-off and another bear trend. There's a 75% chance the breakout will not get very far and then evolve into a trading range, or possibly even reverse. A very strong rally in a tight bull channel, 5-minute chart. If you looked at a higher time frame chart, this would be a breakout, and therefore it's a spike pullback channel. So spike and channel bull trend. Here we have a spike and channel down. We have a broad bear channel. Broad bear channels usually evolve into big trading ranges, and that's what happened here. A broad bear channel has lots of two-sided trading, and at some point the bulls take control and we get a bull leg. The broad bear channel ultimately becomes a bear leg in a big trading range, and that means it'll lead to a bull leg in that trading range. Once the chart starts making a series of higher highs, traders have to exit their shorts because it's no longer a bear trend. It's now a bull trend, and the bears will stop selling if the bull trend is strong. We have a higher low and strong reversal up to a new high. So this is a major higher low. We have a small higher low here, but a reversal up above that high and a very tight bull channel. This, at some point in here, is a major higher low. Any pullback has to stay above that low for the bulls to believe the bull trend is still in effect. I talked about sell zones in broad bear channels. Bears start to sell somewhere in the middle third. If the broad bear channel is mostly sideways, mostly in a trading range, the bears will look to sell further up, maybe in the top third. Traders are always looking to sell a 50% pullback because they know the market's in a bear trend. Therefore, the probability is 60% or more that the market will go to a new low before it goes above a major lower high. Traders therefore sell either with a limit order around a 50% pullback or on a reversal down, expecting a new low. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the 5th of 5 videos on trading broad bear channels.